Hello, this is Brian Rezny, president of Rezny Wealth Management and, of course, host of the Rezny Wealth Report. We've got a great show for you this Sunday. We're taking your questions. Send them to Brian Rezny at ReznyWealth.com. Make sure you get the right answers to all of your questions. Send them on in. We love getting questions on our TV and my radio show. By the way, visit my website, ReznyWealth.com. Every Sunday, my TV show. Every Sunday, we've got our live radio show. Tune me in throughout Florida. You can also call my radio show with live questions in addition to the emails. You know, we've seen volatility. We look at what works in investing. I try to educate investors every week what doesn't work. We're going to talk about some of that today. So I want to discuss what works, what doesn't work, what you ultimately should be doing with your money. Little update on the economy. It's doing pretty darn good. The U.S. economy is growing. Market volatility is here, folks. It's always been here. And by the way, the only investment that doesn't go down, or some people think the only investment that doesn't go down, is bonds. Bonds can go down too. The stock market can go down. All investments go up and down short term. Remember, if you're not a short-term thinker and you're not an emotional investor, you've got a great chance to make a return on your money. So if you're worried about what's going on the next week, day, or month, or quarter, you're probably a nervous Nelly and you're doing emotional investing, which is going to wreak havoc on your portfolio and your investment returns. Rules for investing if you don't want to end up a Walmart greeter at the age of 80. I thought I'd have the title of today's show, The Walmart Greeter, because a lot of investors, I can tell you, at the age 80 don't want to go back to work. Unfortunately, I've been managing money for 20 years. I've seen people that call my TV and radio show. These people end up back in Walmart because they keep doing the wrong things with their money. They either invest in improper investments through brokerage firms. They buy these crazy annuities with high expenses. They basically take too much risk on risky speculation investments, or they don't invest to grow their portfolio the long term, meaning they worry about every up and down of any investment. That's going to be a disaster. Rule number one, take a long-term view, 3 years or longer. And again, I don't care if you're 30 or you're 80, you're a long-term investor if you're not going to spend all of that money that you have in the next 3 years, meaning your portfolio will be liquidated, gone. So as long as you need income from your portfolio and you still need that portfolio to grow to provide more income down the road, whether you're 30, 40, 80, or 90, and you're more than a 3-year time horizon, you're a long-term investor. What I find, though, is a lot of retirees look at this short term. They don't realize when you're 70 or 80, you can live another 15 or 20 years. Your money better be there and grow to provide that income, or you could become a Walmart greeter. Rule number two, hope is not an investment strategy. Expect the worst. Learn from market history. Again, the market isn't just the stock market, it's the bond market. Remember the real estate market a few years back that collapsed over 50-60% in Florida? A lot of those real estate investors lost their shirt because they said real estate only goes up, it doesn't go down. Those are Walmart greeters. Don't allow temporary underperformance to change the investment of your overall portfolio. Too many investors do that. Short-term thinking doesn't provide long-term results. Rule number three, investigate, then invest. And I'm going to repeat that. Investigate, then invest. Study a company's financial statement, a mutual fund's prospectus, an advisor's background. Do your homework. I can tell you when people hire my firm, they check our firm out because we ask them to. We tell them, go to sec.gov, check out our firm. If you're hiring a Wall Street firm right now, go to finra.org. Have you actually checked out your stockbroker or so-called advisor from the bank or the brokerage firm? I can tell you statistically, less than 1% of people do. So you hire people that have repeated bad offenders against their clients and have bad marks on their records. You as the investor need to do your homework, whether it's about your advisor, the firm, the investments you're going to invest in. Do your due diligence. People that are sold annuities all the time never read the prospectus, and then they wonder why they're not happy in 2 or 3 years because their performance and their investments are so lousy in an annuity. Read the prospectus. Do your research. If you're unable to do that, get professional help. Find a fee-only fiduciary firm. Rule number 4, never put more than 5% of your net worth in any one stock. I can see this happen all the time. You know, I've been doing a live radio show and TV show for years. We get hundreds and hundreds and hundreds of phone calls all the time. And I can tell you, a lot of investors overload the boat in a particular stock because they think it's only going to keep going up. And when the stock goes up a lot, they never sell and reduce position weight. They keep adding to it. And then one day, the company goes out of business. And you lose almost all of your money because you overloaded the boat in one stock. I don't care how well you think you know the company. I don't care if you work for the company. Don't overinvest in your company stock or in any individual company. 5% max, no matter how well or how smart you think you are in regards to that stock. Rule number 5, get professional investment management and not from Wall Street. Remember, if you're looking for professional management, look for a fee-only fiduciary advisor. Wall Street banks and insurance companies are not fee-only fiduciary money managers. They're in the sales process, the sales game. I'm always shocked when I hear somebody say to me, I thought my advisor or broker was going to call me to sell. And I tell them, you're working with a Wall Street firm with a brokerage account. Their job is to sell you what they're required to sell. Their job is not to babysit and manage your money. And they're kind of taken back by that. Do you know if your advisor is really managing your money, or do you have a brokerage account, sales, and you are required to do the heavy lifting and investigation and research on your portfolio, and you're the one that's supposed to know when to sell, or do you just keep getting sales calls quarterly and basically selling things so that person can reload a new commission in your retirement account? Number 6, weigh what they say. What do I mean by that? The news, 24/7. When something happens, the news basically keeps talking about it throughout the day and the week. People get nervous. They think the investment markets and the economy are different than they were 30 years ago or 50 years ago. They're not really any different. The problem is people react to news. So people are reactive versus proactive to investing. You need to be proactive. That means research. That means investment strategy. That means knowing when to sell, not reacting to the news and selling at exactly the wrong time. I can tell you a lot of investors, especially the do-it-yourself investor, is reactive and they are not proactive. Rule number 7, costs are killers. If you don't understand what the investments in your portfolio are really costing you annually, you're probably being killed in return. Avoid annuities, avoid non-traded REITs, and avoid broker-sold investments. Your broker is not your friend. Again, their job is to sell you investments their firm represents. Too many investors do not understand the annual, yearly cost of their portfolio. I'll have people say, but my person charges me 1% a year, but it's not the 1% they charge you, it's the other 2% a year in added expenses in the mutual funds that they're selling you each and every year. So now instead of your cost being 1%, it could be 3%. Or in the case of annuity, they could be 4.5% or 5% of your annual cost. That comes against your return and ultimately your income for retirement. How would you like to reduce your retirement income by 30 to 40% a year? I'll tell you how to do it. Buy an annuity. The annuity costs are so high, it takes away huge amounts of your return from the added cost of an annuity. But people don't read the fine print. You as an investor can protect your retirement. Find a fee-only fiduciary in a money manager capacity. Fire your Wall Street broker. Never work with a bank. Never buy an annuity. You'll be better off and you'll thank me later. Henry from Cape Coral, Florida. Is the U.S. headed for recession, or it's just news and media and emotions? Henry, what I will tell you is this. If I look at the U.S. economy, and by the way, we look at indicators for the U.S. economy in parts of the world every single day. From our indicators, we're not seeing any signs of recession. We're not seeing an overheated economy either that usually leads to a recession. Remember what happened in 2008? That was the financial crisis from the banks basically collapsing and not lending money, generally speaking, because of all the bad loans they did from prior years. We're not in that situation. The markets are not overheated. They're not really overvalued. We've got low interest rates. We've got great unemployment. So we're not headed for recession. What I would tell you is this: news media really hurts investors. The other thing that hurts investors is looking at your brokerage statement or going online and looking at your account 3 times a day. Don't do it. Again, you're not a 1 month, 1 week, or 1 day investor. You're invested for the next 3 to 5, 10, 15, 20 years, regardless of age. If you're a smart investor, you look at your account statements once a month just to take a glance. If you're working with a fiduciary money manager. If you're managing your own money, then yes, you should be doing daily research 5, 6 hours a day, studying the markets, the economy, recessionary indicators. Yes, you should be looking at things every day. But I can tell you most investors are not managing their own money. They're relying on Wall Street, but they're checking out their accounts 10 times a day. That will do nothing but stir your emotions and ultimately, in my opinion, harm your portfolio. You know, I've been managing money for 28 years. I do a TV show, I have a radio show that educates and empowers investors every single week. Biggest mistake investors make, one of the biggest mistakes I should say, is making emotional, reactive decisions on their portfolio based upon the news. Turn off the news. If you're making decisions on your portfolio based upon what's already happened, that will lead to bad returns and ultimately more risk. If I look at a few weeks back, we had some of these volatilities in the market. Investors sold at the bottom. When do they buy back in? When things get rosy again and it's already up 10% again. That's how a lot of emotional investors manage their own money. That's a problem, and it's going to cause you harm in your overall portfolio account. Lewis from Cape Coral, Florida. What do you think about investing in oil and XLE? Well, XLE is the Spiders. It's an oil ETF. It buys a basket of oil stocks, service stocks, and integrateds. What do I think about oil? I would tell you this. I think oil is going to be lower than it ever has been, and it could be for the next 1, 2, 3, or 5 years. I don't know if oil is going up next week or next month or 5 years from now. I will tell you, generally speaking, because of technology, because of fracking, because of supply and demand, and the world economy is not growing as fast as they should, we really have an oversupply of oil currently. This may keep oil prices down in that $30 to $40 a barrel price for some time. This means that oil stocks could stay pretty darn low, and it could have a big impact on their dividends, meaning dividend cuts down the road. If you were going to invest in oil, I do like the XLE. I would wait though. What I would say to you is this: pull up a chart, do some tactical analysis on XLE. Wait for the daily price to at least be above the 35-day exponential moving average before you make a move. The economy also needs to start getting a little bit better and robust, including the world economy. But I think ultimately, oil is going to be a great investment and will probably make people a lot of money, just not right now. In fact, there could be a chance before year end, it may go lower. One of the other things to consider, when things are down a lot year to date, people will often start selling those for tax loss reasons in December. So oil will probably do bad or stay low until after tax loss selling sometime mid-December. Watch it then. That might be the buying opportunity of a lifetime. I'm going to take a quick break. Visit my website. Call my firm for a consultation. If you're unhappy with the advice you're receiving, call my firm. Schedule a consultation. I'll be right back after this. Hello, this is Brian Rezny. If your goals are to increase your retirement income and retire without stress, go to my website and download our groundbreaking free report. This free report covers the investment and retirement pitfalls that are often overlooked even by the smartest investor. If you're concerned about outliving your money during retirement, or maybe you want to make sure you're not leaving money on the table, this free report is for you. Know the facts. Your retirement depends on it. Go to my website, ReznyWealth.com, and download your free report right now. And we're back, and we're taking your questions. Please send those to Brian Rezny at ReznyWealth.com. You can also visit my website, ReznyWealth.com, and download any of our groundbreaking free reports. If you're a retiree, a pre-retiree, one of the things I would suggest, if you're not happy with the direction of your portfolio, the performance of your portfolio, you're concerned about the advice you're receiving, you should check out one of my upcoming workshops, Adapt for Success. If you're concerned, you want to learn more about the economy, the markets, proper investing, how to avoid the pitfalls I see a lot of retirees continuously make with their retirement plans, go to ReznyWealth.com, visit my web workshop tab, and sign up and attend one of my upcoming workshops. We'll have a number of these through the end of this year, 2015. You know, before I go to my next question, one of the things that's coming up, and I get a lot of questions on this as of late, is about stop losses, meaning a stop loss, when do you sell a stock, or do I use stop losses when we manage money in a portfolio? We do not use stop losses, and I'll tell you why we don't. When we had some of this recent volatility, some stocks actually gapped down. So I'll give you an example. Let's just say you owned General Electric, symbol GE. And let's say GE is traded at $28, and you put a 5% stop loss under that $28. So if it drops below 5% below 28, it automatically triggers a sell. But it doesn't sell at 5% below, it triggers a sell, people. So when we have this market volatility, GE, let's say, went from 28 down to $21. It blew by your 5% stop loss, and you might have actually sold that stock at, let's say, $21 or $22, or 25, 30% less than current market conditions. Again, stop losses are not the savior. I do not like stop losses for that reason. Often in an overheated market or in a selling frenzy, stop losses are blown by. You get a really low price on your overall stock or what you're trying to sell, and you ultimately hurt yourself. Remember, look at market conditions. Look at recessionary indicators. Watch my show. I'll try to alert you when you should be making adjustments or looking at things more closely, but stop losses, I don't believe in them and I don't like them. Paul from Naples, Florida. I'm just starting to invest. Some inexpensive NASDAQ stocks look attractive for my budget right now. Should I be careful about this approach? Paul, you sure should. If you're a new investor, if you're not an experienced investor, if you do not plan on spending 5 to 10 hours every single day researching your individual stocks, don't buy them. Utilize ETFs, exchange-traded funds. They're already diversified. They mimic a base index or an approach to one of the indexes. You would be much better off buying an ETF, an exchange-traded fund. You're automatically diversified. As an example, if you bought the iShares IVV, fair disclosure, we own that. It's the S&P 500 large cap stocks. If you bought that one ETF, you would own 500 leading companies right here in the U.S. You're instantly diversified. And you don't have to do daily research because you're so well diversified on that ETF. If you buy 4 or 5 inexpensive NASDAQ stocks, you have to know comparables for price, earnings, valuation metrics, earnings power, growth, all kinds of stuff every day. Are you willing to take 5 to 10 hours of your day to do that? If you're not, and I can tell you, you won't be an expert overnight. It's going to take you years to hone your skills. Stay away from individual stocks, even if you're wealthy, because I can tell you this, most people that buy individual stocks take more risk and volatility and end up not even performing in line with the base index, let's say the S&P 500. Joan from Cape Coral, Florida. How can I keep my investing simple? I own 23 stocks and 13 mutual funds through my broker. Joan, that is over diversification. You own 13 different mutual funds and 23 stocks. Why don't you own any ETFs or exchange traded funds? They're way cheaper than your mutual funds, and I could probably tell you that they probably have performed better than your mutual funds. Most mutual funds have an average annualized expense ratio through Morningstar that rates these independently of around 1.65% yearly. The average quality ETF run about 15 basis points, 0.15 versus 1.65. Big difference. Also, 23 stocks. If you're working with a broker, Joan, you are responsible to manage those stocks and research them daily, as I was suggesting to my earlier question. I would avoid the individual stocks. I would look at a portfolio of ETFs. Usually 6 to 8, maybe up to 10 ETFs will give you a well-diversified portfolio in different sectors and different market caps and different strategies. You'll be well-diversified, easy to maintain, proper diversification without being over-diversified at a low cost. Better yet, Joan, why don't you call my firm for a consultation and a second opinion? Maybe you really need professional money management. Tom from Fort Myers, Florida. My mother bought an annuity in her late 60s through an investment advisor she trusted. She got a 300-page book that covered it. Over 15 years, she received about 2% return out of it. She's not happy. What would you do with it? Tom, if she's bought an annuity and she bought it 15 years ago, she's probably past surrender. So what I would suggest is you could take that money out of that annuity and you could put that in a standard custodian account and manage it properly instead of having the expenses of the annuity. Now, one thing you didn't tell me, is this a variable annuity? Is it a fixed annuity? Is it one of these crazy hybrid equity index annuities that really rob investors? That you didn't tell me. So without knowing what kind of annuity she really was sold, it's hard to give you a straight answer. But being that it's 15 years, most of these annuities are past surrender, you can then roll it out of there. Remember this though, whatever she put in, whatever she takes out above what she put in would be taxed. People buy these annuities and they're sold on tax deferral. The problem is the annuity salesperson never tells you when you go to take it out, you got to pay tax at often double the rate of capital gains rates. That's an issue. That's something else that would need to be addressed. I'd say call my firm. Let's take a look at the annuity she has. We do a great job analyzing annuities. We don't sell annuities. We analyze them. We'll give you the right answer so you can make a better informed decision. John from Naples, Florida. Brian, love your show. Thanks, John. You are the only money manager who knows what he's talking about. Thanks for the great advice. Should I hold off on investing new money in the current market? John, what I would tell you is this. If it's new money that you don't need for 3 to 5 years, meaning you're going to deplete it or spend it all to buy a new house or new car, get it invested. The economy is doing well. It's not doing as good as well as it should, but maybe it'll start picking up steam. But it is growing and we are on an uptrend. Any market volatility, I like buying things cheap if I can. So if we get a 5 or 6% pullback and it's an area that I like, we will add to that area on relative strength. So I would not be waiting. Ultimately, you, the investor, needs to get that money invested. Waiting, watching, the markets might go up another 5%. While you wait, they could come down another 5. As long as you don't need it for the next 3 to 5 years, get it invested properly. Do what's right so you can make a return on your money. Lynn from Bonita Springs, Florida. Do you ever recommend buy and hold portfolio go to cash? Yes, we do, Lynn. Not right now, but there are times where we could raise significant amounts of cash as a money manager. In a recession, as an example, let's say your portfolio was mostly stock or equity-based investments in your account. It's more of a growth account. Would I, at that point, during a recession or heading into recession, if our indicators showed us that, would we raise more cash? We sure would. I think it's a fool's game to believe you should be fully invested in equities all the time. I also believe it's a fool's game to think you should be invested in bonds all the time. Remember, bonds go up and down like equities go up and down or any investment. If things get overheated, valuations, economic scenario changes, we start heading into a general recession. It would be time to start raising cash. Investors too often get duped into what I call buy and hold or this asset allocation. Spread it all over with the Wall Street firm. They tell you, oh, don't worry, you're all diversified. But one of the things I find with a lot of investors that do asset allocation, Once they've done it for a while through Wall Street, they realize even though the market goes down, our stuff still goes down. But when things go up, we really don't go up. So nothing ever does anything. You don't make money. You don't lose a lot, or maybe you lose a little bit, but you don't make any money. Asset allocation is a failed approach, and buying and holding onto a portfolio in bad times is a big mistake. Now, I'm not saying that you should sell, your investments every time we get a little turbulence in the market, but I firmly believe recessions happen. They often happen from an overheated economy that needs to slow down, kind of like somebody who's exercising or running. You can't keep running a marathon and a marathon and a marathon. You got to take a break. Our economy does the same thing. Think about this. We've had over 10 recessions in the last 60 or 70 years. Over 10 recessions. Every time it was a pause and a step back for our economy to take the next leg forward, substantial leg forward. Recessions are healthy. I don't see a recession currently in our sights, and we look at a lot of indicators that would trigger and show us the way to a recession. I like what we're seeing. I think investors have to be smart investors. Understand what you own, run a strict investment strategy, make sure as an investor that you have the right person managing your wealth. Are they managing your wealth, or are they selling you investments? A couple telltale signs I try to alert every investor to. If somebody tries to sell you an annuity, they're a salesperson and they don't legally work in your best interest. People are always shocked about that. If somebody tries to sell you a non-traded REIT, non-traded real estate investment trust, a broker, they're not working in your legal best interest. Those are just some of the investments I always tell people to avoid. You as the investor are ultimately going to make the decisions about your portfolio. How's the economy doing? Do I want to grow my money? Do I need income? How do I protect against major catastrophic recessions and things going down? Often investors get complacent when times are good. When things are really rosy, like what we saw back in the real estate boom and bust of 2006, investors decided, let's buy more real estate because real estate keeps going up until it drops 60% in Florida. You, the investor, need not to be greedy. Don't be greedy. Be a little more cautious. That doesn't mean selling all the time. If your portfolio is not performing the way it should, are you happy with the advice you're receiving? Schedule a review and a consultation with my firm. We would love to educate you and empower you for a successful retirement. Don't settle for bad investment advice. Call the number on the screen, visit my website, reznywealth.com, and sign up for one of my upcoming workshops, Adapt for Success. We're out of time, and I'll see you next week.